When it comes to the cannabis sector, as most retail investors know, there has been plenty of pain. All majors from Canopy to Aurora to Tilray have seen massive erosion in market capitalization, revenues, and even growth prospects. But until recently, there was one relatively new name that seemed to escape that fate. Instead, it became a darling of the microcap investor segment. They posted positive EBITDA, made acquisitions on the cheap, and by many standards were becoming one of the majors in the Canadian market, despite their market cap suggesting otherwise. That fairy tale story, however, seems to have gone speeding directly into a brick wall with the release of their fourth quarter financial results, which haven't exactly met the mark. Don't miss the Rural Symposium for Natural Resource Investing happening July 7th in Boca Raton. If you can't make it in person, that's not a problem. You can get your ticket to watch live online or on demand. We'll be there with the deep dive, so if you make it out to Boca, come say hi at our booth. If you want to sign up, click on the link in the description to get your pass. Let's dive in. For those that have been following the Canadian small cap markets, you probably identified by now that we're talking about simply Solventless, or as Xander O over on the CEO boards recently referred to them, simply Insolvent. The company last week published their fourth quarter financial results, which were delayed due to some auditing issues. And now we seem to know what those issues were. We've seen revenue reversals and epic failures to meet previously issued guidance, which notably was released before the company raised several $1 million, which might set them up for some liability issues on top of the mess they've already found themselves in. The market response to the results was not kind, to say the least, with the company seeing their equity fall by over 55% following the announcement. Investors, as you can expect, were a bit peeved by the results. At Investor333 described it as welcome to Canadian microcaps. At Stubborn made his point by suggesting a change of the symbol to trash. At Cyborg took the more adult route in the conversation, suggesting that the results were tough, but his own investment performance was on him for ignoring the red flags. While at Impossible Bro commented that turns out Canada Biz were the good guys. At least it's clear now why the guys over at Canada Biz walked away from a proposed merger earlier this year. With all that being said, let's get into the results here. Simply Solventless in the fourth quarter of 2024 recorded gross revenue of $6 million, an increase of 233% on a year-over-year basis from $1.8 million in the fourth quarter of 2023. While positive, gross revenue was guided to come in at $11.8 million for the quarter. And subsequent to quarter end, the company raised $6 million in convertible debt following the release of that guidance, before the results were actually out, which might cause some problems. So what happened? Well, the company was booking revenue that wasn't actually revenue. In the fourth quarter, Simply was forced by their auditors to de-recognize $4.3 million in tolling service revenue. Basically, what was happening was that tolling services were being paid in kind, with an equivalent value of the processed end product being recorded into inventory. But even with this revenue de-recognition, it should be noted that Q4 revenue came in short of guidance, with revenue ex de-recognition totaling $10.3 million on a gross basis, versus guidance of $11.8 million. This derecognition of revenue also resulted in a reduction of $683,000 in cost of goods associated with this booked tolling revenue. More on that in a second. After excise duties, net revenue in Q4 totaled $3.5 million versus $1.3 million in the year-ago period. And then there's the cost of goods sold, which ballooned from $827,000 to $7 million on a year-over-year basis, even after backing out that previously mentioned $683,000. Part of the issue here is that Simply was not fully recognizing overhead costs in the first 9 months of 2024, resulting in a reconciliation adjustment of $3.1 million. In other words, those margins they previously bragged about didn't properly factor in all costs. Gross profits for the fourth quarter as a result of these major adjustments, which Simply is quick to highlight are non-cash, turned negative at $3.6 million versus positive $484,000 in the fourth quarter of 2023. After a further $2.1 million in SG&A, the loss from operations came in at $6.2 million for Q4, versus income of $40,000 in the year-ago period. Net income overall came out to negative $6.9 million, or a loss of 10 cents per share, versus a loss of $1 million or 2 cents per share in the year-ago period, which is also after Simply had previously guided to positive net income of $2.6 million for the quarter. EBITDA, meanwhile, came in at negative $6 million, while adjusted EBITDA was negative $5.3 million, ending a multi-quarter streak of positive adjusted EBITDA. As for the full year, things aren't quite as awful. Simply in 2024 recorded gross revenue of $20.5 million, which was up substantially from $7 million in 2023. On a net basis, revenue grew from $6.2 million to $13.7 million, an improvement of 121%. But this growth came at lower margins. Gross profit dropped from $3.5 million to $1.2 million on a year-over-year basis, a decline of 66%, while gross margins dropped from 56% to just 8.6%, which isn't great. SG&A, meanwhile, rose dramatically as well, jumping 261% as it went from $1.2 million to $4.4 million. This growth in expenditures ultimately led to the company posting a loss from operations of $4.1 million for 2024, as compared to income from operations of $2 million in 2023. Net income, meanwhile, fell from positive $1 million or 2 cents per share to a net loss of $5.2 million or 8 cents per share. Simply is also nowhere near cash flow positive either, with cash used in operations ballooning from $408,000 in 2023 to $5.8 million in 2024. The company, meanwhile, ended the year with cash and equivalents of $1.9 million and positive working capital of $1.6 million. Although inventory accounts for $16.1 million of those current assets, which is roughly a quarter and a half of Q4 revenue before you factor in all those adjustments. So it's unclear how realistic that inventory number actually is. These products have a shelf life. Subsequent to quarter end, Simply was able to also settle $3.4 million in promissory notes via the issuance of shares at 50 cents per share, which helps clean up the balance sheet a bit. All right, so let's wrap it up. Where does Simply go from here? Well, CEO Jeff Swainson provided the commentary that all things being equal, it is SSC's view that the non-cash changes to accounting treatment will positively impact future revenue, profitability, and cash flow. Gross margins remain strong, and the size and capability of our asset base improved significantly during 2024. That being said, they've arguably lost the trust of investors with these results. And they also didn't reiterate previously issued guidance for Q1, the results for which are delayed and expected to be released as soon as possible. We'll reserve our judgment for when those results come out. All right, everybody, thanks for watching. I always love when we get to cover just the boring old micro-cap story. I know people don't think cannabis is that boring, but we got revenue, we got cost of goods sold, we've got an income statement to look at as opposed to some of these exploration and development stage companies. Guys, if there's stories you want us to cover, let me know in the comments section. Also, if there's things we've missed or people you want us to have on an interview, we're always open to ideas. Guys, do me a favor, if you enjoyed this video, smash that like button, subscribe, ring that notification bell. All right, everybody, thank you for watching.